Imagine you've done everything right. You spent 30 years maxing out your 401k. You lived below your means. You didn't touch the account when things got hard. And now, at 65, you're sitting on $1.2 million in your retirement accounts. That's not a problem. That's a success story. Except for one thing. Every dollar in that account has never been taxed. And the IRS has been very patient because they always knew they'd collect. They just let you decide when, except starting at age 73. They stop letting you decide. They send you a bill every year, whether you need the money or not. And for millions of Americans, that bill is going to be the largest tax event of their entire lives. Today, we're going to talk about what that looks like and what you can do about it before it's too late. I'm Jason, and I'm a financial advisor who works with families and people planning for retirement. I make these videos because the financial decisions that matter most are often the ones nobody explains until after the damage is done. The retirement tax bomb is one of those topics. Most people don't hear about it until they're already in their late 60s, and by then, the window to do something meaningful about it has significantly narrowed. So whether you're in your 40s, your 50s, or already in early retirement, this video is worth your full attention. Because the earlier you understand this, the more options you have. Let's start with the basics. When you opened a traditional 401k or a traditional IRA, you made a specific agreement with the federal government. And most people, understandably, only focused on one side of that agreement. The side they focused on is that every dollar you contribute reduces your taxable income today. If you earn $120,000 and contribute $20,000 to your 401k, you only pay income tax on $100,000. That's real money saved right now, every year. The side most people glossed over is that every dollar that comes out in retirement is taxed as ordinary income, not at capital gains rates, not at a flat rate, as ordinary income, the same rate you pay on your salary. And not only are the withdrawals taxed, the growth is taxed too. That $20,000 contribution that grew to $200,000 over 30 years, all $200,000 comes out as taxable income when you withdraw it. For most people, that still sounds like a reasonable deal. You got the tax break up front when you needed it. You'll pay taxes later when you're retired and presumably in a lower tax bracket. That logic works, sometimes, but it contains two assumptions that are failing for a growing number of Americans. Assumption one is that your tax rate in retirement will be lower than your tax rate while working. Assumption two is that you'll control when and how much you withdraw. Both of those assumptions get shattered by three letters, RMD. Required minimum distributions, or RMDs, are the IRS's way of saying we've been patient long enough. Start paying us. Starting at age 73, that's the current age under the Secure 2.0 Act, the IRS requires you to withdraw a minimum amount from your traditional retirement accounts every single year. Traditional 401ks, traditional IRAs, SEP IRAs, simple IRAs, all of them. And the amount isn't small. It's calculated based on your account balance and your life expectancy using IRS tables. In your early 70s, you're typically required to withdraw roughly 3.5 to 4% of your account balance per year. By your late 70s and 80s, that percentage climbs. Let's run a real scenario. You're 73. You have $1.2 million in a traditional retirement account. Your RMD that year is approximately $46,000 based on IRS life expectancy tables. You'll also receive $28,000 per year in Social Security. Your total income that year is $74,000. You're now squarely in the 22% federal tax bracket, potentially higher depending on your state. But here's where it starts to compound. Up to 85% of your Social Security benefits becomes taxable once your combined income exceeds $44,000 for a married couple. So that $28,000 in Social Security, now up to $23,800 of it is taxable income on top of your RMD. Your actual taxable income isn't $74,000, it's closer to $70,000. Then you'll account for the standard deduction, and that's before we talk about what happens if your account keeps growing. Because here's the part that catches people completely off guard. If you have $1.2 million in a retirement account at 73, and the market continues to grow at a moderate rate, your balance may be higher at 75 than it was at 73, which means your RMD at 75 is larger, which means your tax bill at 75 is larger. A large 401k balance doesn't reduce your future tax burden, it grows it. There's a third layer to this that I want to spend a few minutes on, because it blindsides even financially sophisticated people. It's called IRMA, or the Income-Related Monthly Adjustment Amount. Medicare Part B and Part D premiums are not a flat rate for everyone. They're income-based. If your income exceeds certain thresholds, your Medicare premiums increase, and significantly. In 2026, a married couple with an income above $218,000 in 2024 pays more than the standard Medicare Part B premium. Above $274,000, it's nearly double. Now, most retirees don't have income anywhere near these levels. But here's the catch. RMDs count towards that income calculation. And Roth conversions, which we'll discuss in a moment as a solution, also count in the year you do them. So picture this. You're 74 and it's 2026. Your RMDs are generating $60,000 a year in taxable income. You decide to do a large Roth conversion, converting an additional $80,000 from your traditional IRA to a Roth. Your income that year jumps to $140,000. You've now crossed an IRMA threshold for a single filer. Your Medicare premiums in 2028, because IRMA is based on income from 2 years prior, increases by a couple of $100 per month. That Roth conversion that was supposed to save you tax money in the long run just cost you in the short run. Not because the strategy was wrong, it may still have been right, but because it wasn't coordinated with the Medicare premium calendar. This is why I call it a tax bomb and not just a tax bill. It's not one explosion, it's a chain reaction. RMDs push up income. Higher income makes Social Security taxable. Higher income triggers Medicare surcharges, and each of those things feeds back into the others. The families who navigate this well are the ones who saw it coming 5 to 10 years earlier. The families who get hurt are the ones who discovered it at 73 when the first RMD notice arrived. Let's talk about the most powerful tool available to defuse this bomb before it goes off, the Roth conversion. Here's the core idea. A Roth IRA and a Roth 401k operate on the opposite tax logic from their traditional counterparts. You contribute after-tax dollars. The money grows tax-free, and withdrawals in retirement are completely tax-free, with no RMDs required during your lifetime. A Roth conversion is the process of moving money from traditional retirement account into a Roth account. You pay income tax on the amount you convert in the year you convert it, and then that money and all of its future growth is never taxed again. The strategic window for Roth conversions is the gap between when you retire and when RMDs begin at age 73. For many people, that's a period of 5 to 15 years where income is relatively low. You've stopped working, you may be delaying Social Security, and you haven't yet hit mandatory withdrawals. That window is arguably the most valuable tax planning period of your entire financial life, and most people waste it. Here's how a thoughtful Roth conversion strategy works in practice. You retire at 62. Your Social Security start date is 67 or 70. For the next 5 to 8 years, your taxable income is relatively modest. You have room in the lower tax brackets in the 10, 12, or even 22% range that isn't being fully used. Each year during that window, you convert a carefully calculated amount from your traditional IRA to your Roth IRA, filling up the available space in your current tax bracket without pushing yourself into the next one. You pay tax on the conversion today at your current rate, and in doing so, you're permanently reducing the balance in your traditional accounts, which directly reduces your future RMDs. Let's look at what that does to the math. Scenario A, no Roth conversions. At 73, your traditional IRA balance is $1.4 million. Your first RMD is approximately $53,000. Combined with your Social Security, your annual income is $80,000 or more. You're in the 22 to 24% bracket for the rest of your life, and your account continues generating larger RMDs as long as it grows. Scenario B, Strategic Roth conversions from age 62 to 72. You've moved $500,000 from traditional to Roth over 10 years, paying tax in the 12% bracket. Your traditional balance at 73 is now $900,000 instead of $1.4 million. Your RMD drops to approximately $34,000. Your Social Security is less taxable. Your Medicare premiums may be lower, and you have a $500,000 plus Roth account, generating tax-free income for the rest of your life. The tax you paid on those conversions doesn't disappear, but you paid it at 12% instead of 22 or 24%. On $500,000, that difference is between $40,000 to $50,000 kept by your family rather than sent to the IRS. And that's before accounting for tax-free compounding on the Roth balance for the next 15 to 25 years. Roth conversions are the centerpiece of retirement tax planning, but they're not the only tool. Let me walk you through a few others worth knowing. Qualified charitable distributions, or QCDs. If you're 70 and a half or older and you give to a charity, a QCD allows you to transfer up to $111,000 per year directly from your IRA to a qualified charity. That transfer counts towards your RMD, but it never appears as taxable income on your return. For charitable retirees, this is one of the cleanest tax moves available. You satisfy your RMD, you support causes you care about, and you reduce your taxable income dollar for dollar. Health Savings Account, or HSAs. If you're still working and enrolled in a high deductible health plan, an HSA is the only account in the tax code that gives you a triple tax benefit. Contributions are pre-tax, growth is tax-free, and qualified withdrawals are tax-free. And unlike an FSA, the money never expires. After 65, you can withdraw HSA funds for any purpose, not just medical, and pay only ordinary income tax, making it function like a traditional IRA with an added bonus for healthcare expenses. Maximizing HSA contributions in your 50s and early 60s and not spending it down gives you a meaningful pool of tax-advantaged funds specifically designed to absorb healthcare costs in retirement, which is often the largest and most unpredictable expenses retirees face. If you have investments in a taxable brokerage account, strategically realizing losses in down market years can offset gains and reduce your taxable income. This is a more advanced strategy, but one worth understanding as part of a comprehensive retirement tax plan. Here's the question I want you sitting with as we close out this video. How far are you from 73? If you're 55, you have 18 years. That's a meaningful Roth conversion window. The math can work very substantially in your favor. If you're 62, you have 11 years, still a strong window, especially if you're retiring soon and entering a lower income period. If you're 68, you have 5 years. The window is narrowing, but 5 years of disciplined conversions can still make a material difference. If you're 72, the window is almost closed. At this point, the strategy shifts from prevention to management, optimizing how you draw down accounts, using QCDs, coordinating withdrawals across account types to stay in the most favorable tax bracket. The families who handle this best are not the ones with the most money. They're the ones who started paying attention to the tax dimension of retirement before it became urgent, because the IRS doesn't offer extensions. At 73, that first RMD notice arrives on schedule, regardless of whether you plan for it. And the unfortunate reality is that most financial conversations focus on accumulation, building the balance, growing the account, picking the right funds. The tax strategy conversation often gets deferred, and by the time someone asks, wait, how much of this is actually mine after taxes? The answer is smaller than it should have been. That's the tax fault. It was always there. It just hadn't gone off yet. Let me leave you with the headline. A large traditional retirement account is a tremendous achievement. It represents years of disciplined and sacrifice and delayed gratification. Nobody should feel bad about having built one, but it is not a tax-free asset. It is a tax-deferred asset, and there is a significant difference between those two things. A difference that, without planning, could cost you tens of thousands of dollars in unnecessary taxes during the years when your income is fixed and every dollar matters most. The Roth conversion strategy, the QCD strategy, the HSA strategy, these are not loopholes. They are the tax code working exactly as designed. They reward people who understand the rules and plan accordingly. And the best time to start understanding them is before the clock reaches 73. If this video raised questions about your own retirement accounts, about how much of your balance is truly yours after taxes, or whether a Roth conversion makes sense for your situation, I'd encourage you to have that conversation with myself or a financial advisor who can model your specific numbers. Subscribe to this channel if you want to keep building this kind of knowledge. Every other week, we cover the topics that directly affect your financial future, clearly, practically, and without the noise. I'll see you in the next video.